They wear suits, carry briefcases, and make deals worth billions. They look like geniuses. They sound like geniuses, and the world treats them like geniuses. But here's the truth nobody tells you. Most of what they do has almost nothing to do with math. It's not research. It's not strategy. It's persuasion, confidence, storytelling dressed as finance, high-risk deals, complex products. They are all tools in a sales game most people don't understand. The money flows, the headlines roar, and the victims? They are already forgotten. By the time regulators show up, the machine has moved on, and the most charismatic players walk away with their reputations intact. This is what investment bankers really do, and why the system keeps letting them get away with it. The official story of an investment banker is simple, polished, and very expensive. They are the smartest people in the room. They wear tailored suits, speak in acronyms, and move numbers that most people will never touch in their lifetime. While the rest of the world worries about rent, investment bankers worry about billions. According to the story, this is what they do. They analyze companies. They build financial models that predict the future. They price risk, value businesses, and decide what something is truly worth. When a company wants to go public, they are the ones trusted to guide it. When a corporation needs money, they raise capital. When two giants want to merge, they sit at the center of the deal and make it happen. This story is carefully marketed. To college graduates, it is sold as prestige. Long hours, yes, but legendary bonuses. A few years of sacrifice for a lifetime of doors opening. Goldman on the resume, Morgan Stanley on the business card. Proof that you made it. To clients, it is sold as expertise. These are the adults in the room. Calm, confident, precise. They speak the language of markets and promise access to opportunity, growth, and scale. To the public, it is sold as myth. Movies, media, headlines about record deals and historic IPOs. The image of finance as a high-stakes chess match played by brilliant minds in glass towers. This is the version everyone is taught to believe. It is clean, it is impressive, and it is only the surface. Look closer, and the math starts to fade into the background. The spreadsheets are real, the models exist, but they are not the engine. They are the decoration. What actually moves money is not numbers. It is persuasion. At its core, investment banking is a sales business. Not in the obvious way. No name tags, no door-to-door pitches. Instead, it is persuasion dressed up as analysis, confidence framed as expertise, a narrative wrapped around a balance sheet. Because stocks are not just ownership, IPOs are not just capital raises, bonds are not just debt. They are stories, carefully constructed, selectively framed and delivered to human beings with fear, greed, and limited attention. The numbers support the story. They rarely lead it. This is where the image shifts. The investment banker stops looking like a financial genius and starts looking like a high-pressure sales operator with better vocabulary. The job is not to discover truth. The job is to make something sound inevitable, urgent, and rational enough to buy. This skill is transferable. It works when selling meat door to door. It works when pushing penny stocks no one understands. It works when pitching billion-dollar deals to institutions that should know better. The product changes. The structure changes. The psychology does not. If you can sell belief, the product becomes optional. That is the first uncomfortable realization. The thing that separates winners from losers on Wall Street is not superior insight. It is the ability to make other people believe in your version of reality long enough for the deal to close. And once you see that, the rest of the system starts to make sense. Once persuasion becomes the engine, incentives become the steering wheel. On paper, the system looks reasonable. Fees for services rendered, commissions for deals closed, bonuses for performance. Simple, clean, objective. In practice, those incentives decide everything. Compensation in investment banking is rarely tied to long-term outcomes. It is tied to volume, to transactions completed, to how much money moves, not what happens after it moves. Whether the deal succeeds in 5 years matters far less than whether it closes this quarter. That single detail changes behavior. High-risk products suddenly make sense, not because they are better for clients, but because they pay better. A complicated structure earns higher fees. A risky IPO generates excitement, urgency, and larger commissions. A product few people fully understand is easier to sell confidently because questions slow momentum. And all of this can happen legally. The paperwork is signed. Disclosures are buried. Risk is technically acknowledged. Responsibility is shifted just enough to keep the system clean on the surface. No laws broken. No obvious villains. Just incentives doing exactly what they were designed to do. This is why the same patterns repeat. Penny stocks that should never be sold. IPOs priced for hype instead of durability. Financial products so complex that understanding them becomes optional, even for the people buying them. It is tempting to blame individuals, a greedy banker, a reckless firm. But this is not a character flaw problem. It is a structural one. The system does not reward accuracy. It rewards conviction. It does not promote truth-tellers. It promotes closers. And once you understand that, the outcomes stop looking accidental. At first, this behavior looks personal. One banker, one pitch, one deal. Then, it gets scaled. Once a method works, Wall Street does what it always does. It systematizes it. What began as instinct becomes training. What was once talent becomes a script. Persuasion is no longer an art. It is a process. New hires are not taught to understand markets first. They are taught to perform. How to control a conversation. How to create urgency. How to overcome hesitation. Objections are anticipated, categorized, and neutralized. Confidence is drilled in until it becomes muscle memory. Hiring follows the same logic. Experience is optional. Hunger is not. Firms do not look for people who ask too many questions. They look for people who can endure pressure and apply it. Aggression beats caution. Energy beats nuance. Understanding slows things down. The environment does the rest. Floors packed with ringing phones. Managers pacing behind desks. Rankings on screens. Praise for closers. Silence for skeptics. The imagery changes, but the structure stays familiar. Boiler rooms. Assembly lines. Places where output matters more than reflection. And this is where control disappears. Once the machine is running, no single banker decides the outcome. The incentives push, the scripts guide, the pressure compounds. Deals move not because they should, but because the system demands movement. The machine does not care about intent. It does not care about consequences. It only cares about throughput. At scale, damage is no longer an accident. It is a byproduct. And by the time anyone notices, the factory is already at full speed. For a while, the machine looks unstoppable. Aggressive selling drives demand. Demand inflates value. Prices rise, headlines follow, and confidence feeds on itself. As long as the story holds, everyone wins. On paper, then reality intervenes. The numbers stop cooperating. Earnings miss expectations. Liquidity dries up. The narrative that once felt inevitable suddenly feels fragile, and when belief breaks, it breaks fast. This is the pattern. Inflated value collapses back to something closer to truth, sometimes slowly, often all at once. The same urgency used to sell is replaced by silence. The outcomes, however, are not shared equally. For bankers, there are bonuses already paid, promotions already earned, exits carefully timed. In the worst cases, there are legal settlements, fines that look large in headlines, but small compared to the money moved. Careers dented, not destroyed. For investors, there is no reset. Retirement accounts shrink, savings disappear, debt replaces hope. The losses are permanent, and the recovery, if it comes at all, takes years. Often, there is no one left to call. Eventually, regulators arrive. Investigations begin, documents are requested, phone records examined, and when pressure builds, insiders flip. Emails surface. Conversations are reinterpreted. The machine starts to turn on itself. But punishment is uneven. The quiet participants fade away. The least protected take the fall. And the most charismatic players, the ones who sold the story best, often survive the longest. By the time accountability appears, the damage is already done, and the bill has already been paid. The story does not end with collapse. In finance, scandals rarely disappear. They rebrand. What began as fraud becomes a memoir. What destroyed thousands of lives becomes a movie deal. The same behavior that triggered investigations is repackaged as hustle, ambition, and raw intelligence. The language changes. The harm does not. A criminal becomes a character. A scheme becomes a lesson. A collapse becomes content. Speaking tours follow. Podcasts. Panels. The narrative shifts away from consequences and toward charisma, toward confidence, toward the idea that the real crime was getting caught. And slowly, the victims fade out of frame. The teacher who lost a pension does not get a book deal. The family that emptied savings does not get a redemption arc. Court-ordered restitution remains unpaid. Losses sit quietly on balance sheets that no one revisits. The money does not come back. The story moves on. This is the final irony. Investment banking, at its extremes, is less about finance and more about storytelling, about who controls the narrative, about incentives that reward confidence over caution, volume over outcomes, and power over accountability. The system does not need everyone to believe it. It only needs enough people to keep buying the story. If you want more breakdowns like this, the kind that slow the story down and look at what actually happens beneath the surface, subscribe to Paper Money, because money never stops moving. It just changes the story it tells.